Thank you very much. So I think that, what we're going to do this afternoon is, I'm not sure if George knows what I'm going to do. So he's been, I think, nervous because I'm not maybe a traditional speaker at this type of conference. But how it came about was the partnership with Fairfax. So Prem Watsa is the majority shareholder in our company, and Prem and I have been together since 2018. And so what I'm going to do today is I'm going to kind of talk about the story, and I'm going to kind of give you guys the journey and talk about the fundamentals of a sector and how we look at that in terms of building the value investing approach. And so, again, I'm a founder. So, again, it's great to be in front of you. So, I always like to tell the story to start to say, I did what every responsible young man does. My wife was 6 months pregnant with twins. I quit my job in the government of Canada. I moved to the basement of my house with a blank sheet of paper and wrote a business plan on how to build a lentil processing company based out of Saskatchewan and take it to the world. And so I remember my wife saying, the first question was, what are lentils? That was the first question she asked. And then the second question was, how are we going to put diapers on our babies? And I convinced her that, it was the right approach to, we were young. I was 27 years old. We were educated. We met at business school. And we wanted to take a chance to build a Canadian champion. And, ultimately, the general investment thesis was, again, something that when we look at, 25 years later, starting, with a blank sheet of paper, we built up the revenue to about $3.5 billion, and we're continuing to move. But the general thesis was arable land and water loss in the world. So, looking at kind of, the general start of a thesis is global population is growing. Okay, demand for protein is growing, and the scarcest resources in the world are land and water. And so when we turned around and looked at that, ultimately Canada was an important place in the world, to feed food security. So, I'm a Turkish immigrant. I was born in a little community in Saskatchewan called Davidson, 1,200 people. So my parents moved there in 1965, looking at a new life in Canada. I was born in a small rural hospital. And as I grew up, every third field around our community was summer fallow. So what that means is a farmer would grow wheat, then they'd grow canola, and because they use so much nitrogen fertilizer, they had to leave their soil to black dirt. So every third year, a Canadian farmer didn't get to grow a crop. The alternative to that was to plant a nitrogen-fixing legume that could actually fix nitrogen in the soil instead of requiring nitrogen fertilizer. So that was the foundation of my business plan was, what if we could convince farmers to grow lentils and chickpeas and beans instead of leaving to summer fallow their cropping land? And, I went region to region in Saskatchewan, community to community, convincing them to grow lentils, chickpeas, peas, and beans. So it does kind of bring new meaning to the word, I'm a bean counter. So, again, I'm proudly a bean counter, but in a very different manner than what I expected. So what we've done is, again, started with one small factory in Canada. We built in Regina a factory that would take from farmers lentils and process them and start to prepare them for consumption in the world. And today there's 40 manufacturing facilities in 5 continents around the world. We actually did drive that transformation. So when I started the company, lentils, chickpeas, peas, and beans were not a crop that were grown. Today, Canada grows 12 million acres of these crops. And 20% of the world's lentils pass through our factories. So we're going to talk about kind of that fundamental of what kind of, took us and now what is driving the next evolution of the company. So what did Fairfax see when in May of 2018, it was a Saturday morning and my phone rang. So if any of you know Prem, Saturday morning is the time where he loves to make the phone calls that matter the most to him. So it was 7 o'clock in the morning in Saskatchewan. Which was, I think, at that time would be 8 o'clock in the morning in Ontario. And my phone rang and it was, Murad, this is Prem Watsa. Well, I'd never spoken to Prem in my entire life. And Prem had said, well, my people had prepared up a brief for me and I really like what I see. Would you let me be your partner? So that's how it started. And the very first instrument we did with Prem was, you want to talk about value investing. We were a public company at the time. It was a 99-year no-call convertible debenture with a fixed coupon. So that was, again, his way of signaling to the market that this was permanent capital. So we'll talk more about those. But, fundamentally, when we look at, the world and we look at, kind of what we've talked about building is an integrated supply chain. Now, the one thing I want you guys to recognize as a value investor is, I even heard it out of our panel one today. Commodity is not a bad word, okay? Commodity is a bad word because the fundamental definition of commodity is price taker, right? That's fundamental economics. But if you have an integrated supply chain where you're actually creating an advantage on origination, on being able to hedge off physical commodity risk, and you're able to transform that commodity in an integrated supply chain, that commodity supply chain becomes your competitive moat. It doesn't become it becomes your kryptonite, not your Achilles heel. So imagine from the basement of my house, we built a business where we shipped last year 97,000 ocean containers to 127 countries around the world. We are, we believe, among the 3 largest food exporting companies and containers in the entire globe. So when you look at, what you build, it's, a business model where you take a commodity base of origination from farmers and you ultimately transform into consumer trends. So that's what we're going to talk about. And what you do is, I always say agriculture is the worst business in the world and it's the best business in the world. Because it's high CapEx, high working capital. That already sounds bad, right, to all of you? But actually when you do establish scale, big competitive barriers to entry, big competitive moats, and when you actually put in place value-added processing, process engineering, and technology and innovation, you can create something that can be quite resilient. And then when you do that, and you ultimately create your footprint, modular CapEx strategies are very interesting. And a modular CapEx is big, lumpy assets that can ultimately be expanded on small modules where the first asset return on invested capital might be subpar, but the incremental modular CapExes are very, very superior returns. So over time, a value investor can achieve superior return on invested capital by tacking on modulars onto the initial CapEx. We'll talk about that as well. And then, the other part is, experience. One of the big problems we have with emerging markets and North American companies, and Canadians we're quite bad as well, is we are really inexperienced. So, experience in the emerging markets, resiliency, consistency. We like to drive by markets and sell. We don't like to understand markets and be in markets time and time again. I always say in my journey in business, I never went to Paris, New York, or London once in the first 15 years, but I went to Chittagong, Bangladesh, Algeria, and, I walked the market in Karachi every year 3 times, right? So that's the way, you kind of build. I want to take you up now, so ultimately let's talk about kind of fundamental trends and why, when we look at sectors, I think it's important to understand how these trends kind of interact. Global population growth I mentioned. 9.5 to 10 billion people by 2050. That's an interesting trend. But the more interesting trend to me is rising incomes in the emerging markets. So when we look at, the rising income side of population growth, you fundamentally have what I would call, kind of a change in consumer behavior coming. We don't understand what rising incomes mean. When you talk about emerging markets, you're talking about subsistence consumer going to a consumer who has a certain level of disposable income. Now, what do you do with your first level of disposable income? You don't buy a Gucci shoes or designer boots, you actually eat more protein. Okay, so that's what you do, is you change your diet. That's what happens. So we're going to talk about that. Global hunger is a real part of the world today. I think we have to recognize that, again, this isn't about philanthropy. It's about recognizing that there's global hunger, but then there's also a mismatch. I say North American consumers, we make bad dietary choices by choice. In the world, there are about 3 billion people that go to bed at night that actually have a relatively full tummy, but they are eating the wrong thing, and it's not by choice, it's by availability and affordability. So you have a massive transformation coming in the food system in the world that's going to be an interesting trend to watch. Arable land loss, as I mentioned, urbanization, water use. To produce a pound of beef, is 1,857 gallons of water. To produce a pound of lentils, 43 gallons. Now again, I'm not suggesting, I loved the meat today, the beef on the buffet, thank you George, but I would have preferred to have a side of chickpeas with that. So next time we're going to make sure we do that. In fact, I'm going to tell Prem to tell you that we have to do that next year. So we'll make sure there's chickpeas on the menu. Sustainable and regenerative agriculture is a phenomenon that actually will be driven by the farmers themselves. This is not new. Soil health is farmers protecting their asset. Their asset is the soil. So, what we see is this sustainability side, not something that's going to be driven by governments, but going to be driven by farmers themselves and consumers. And then smart capital is going to drive it even more. So while we have a president in the White House today who says, environment, social, and governance doesn't matter, I disagree. I think that the consumer of the future, those twins that I mentioned, are now 25 years old. And my daughter, Sarah, is a perfect example. She's pursuing her PhD in organizational leadership. She's not an environmentalist, but she's a highly conscious, highly intelligent young woman who makes her decisions as a consumer based on her values. She actually buys from companies that she feels fits her value system. So those are the type of trends that I think will continue to drive things. So this global dynamic that we talk about is that population growth, food insecurity, staple diets, and then this interaction of middle-class spending, 33 trillion in Asia by 2030. Right? Again, this is a trend that we as North Americans have to recognize is not only coming, but it presents the growth opportunity, for us to realize where our niches are. And I'm going to use a term in my talk here today, which is niche on a large scale, which is completely counterintuitive. If you can create scale in a niche, you ultimately create a value investing thesis, because in a lot of cases you have limited disclosure of information, you have limited price discovery on crops and on food systems that are not futures traded, right? Futures trading ultimately gives price discovery. Margins get created by the limited lack of price discovery in markets around the world. Lentils, chickpeas, peas, and beans are not futures traded commodities. On a daily basis, we can see the lentil price in Turkey and India, divergent by 12% per day, in a different time. So there's a lot of arbitrage and things that we'll talk about as well. So when we kind of look at the market opportunity in a general sense, it's all the interaction of these things. Global demand, right? We chose staple foods, things that we didn't have to create a demand profile for. Pasta, right? North Americans, we keep saying we're eating less pasta. You're all lying, okay? Because the trend is that pasta consumption is rising. Now, in emerging markets around the world, pasta consumption is rising even faster, 6.8% CAGR. Why? Rice is 6% protein. Pasta is 13% protein. So it is an affordable. So pasta and noodles are growing in emerging markets around the world, right? You have to have, positions in fast-growing international markets. We can't service those markets from faraway places. Although we grow in Canada, we located our processing assets in 5 continents around the world. Canada, the US, Australia, feeding a processing infrastructure in South Africa, Turkey, India, Kazakhstan, right? Those are kind of regional points and then distribution points around. And when we look at kind of this plant-based foods, it's critical to delivering food security objectives. So, when I look at, what's happened over the last month in the Middle East crisis, we're getting phone calls now from foreign governments to say, we're worried about our food supply because the ports have been closed now for over 5 weeks. When this crisis breaks, how are we going to refill the supply chain? Right? These are not discretionary items. And then we see this trend in the world that retailers are actively investing and growing in their own brands. Now, I want to give you a little, again, everybody's been talking about Mr. Buffett today, and I'm going to give you a very fascinating kind of a snippet from an interview I saw with him lately. And, for many, many years, Warren would talk about, Heinz and Kraft and the global brands. You must own them. They have to be in your portfolio. And, it was a segment where he was acknowledging Heinz and Kraft last year sold $26 billion at retail in the world. Kirkland sold $38 billion alone last year in the US. Okay, so anyone who thinks that Kirkland, right? President's Choice and No Name, Aeon Japan, Carrefour brand, Aldi brand, Whole Foods, Trader Joe's are not powerful brands today, are behind, right? They think of them as private label, you're missing it. Why are they changed? The retailer owns the shelf, which is the real estate. They own the planogram, which is the placement on that shelf. They own the flyer, which is your predictor of how quick your product will sell. And they ultimately own, the brand that is on that shelf. So when we look at that kind of fundamental, we see again a trend that we're capitalizing on to say that plant-based foods are affordable. This is one of the things that's driving the demand profile. And, North America, we sit here and you buy a bag of lentil chips and they're $8 a bag. That's not affordable. Okay, but you know what? In the world, the format has to be affordable. And so when we look at that, kind of ultimately, we're seeing, kind of how we're attacking it by looking at, kind of the interrelated segments of our business. So we started with a distribution segment originating from farmers and moving product around the world. Then we built the value-added processing factories, and now we built a packaged foods business. Right, the packaged foods business, when we took the company private in 2019 with Prem, was 18 million of EBITDA. We went out public a month ago, 96 million of EBITDA in that segment. So a growth from 18 million to 96 million in a 5-year period. More importantly, the free cash flow and the margin profile in this segment is double or 2.5 times the traditional business. So when we look at what we're doing in that segment is we're producing the store brands of the world. So if I told you that every yellow no name and every President's Choice package of pasta and every banner of Loblaws in this country, I produce it at my factory in Turkey, you might be surprised. Carrefour brand in 29 countries around the world, we produce. Aeon Japan, we're the global sole supplier of pasta. So, from that perspective, you look at the trends of what's going on and you recognize that, you're building onto the strategy, right? You have a supply chain that you build into value add, which builds into packaged foods, which ultimately gives you top line, growth, and then ultimately free cash flow growth. Now, why did we go public again? We had a growth trajectory where we were working for the banks in the world. So we went out and raised our money and retired $1 billion of debt on the day of the IPO, right? So, ultimately, the Fairfax mantra in this case is 200 million of EBITDA, right? The day of the IPO, we created $80 million in free cash flow growth. Right, just by retiring debt. So you ultimately, try and take a look at it, and what you're doing is trying to create, again, fundamentals focused on free cash flow, fundamentals focused on reinvestment in a modular strategy. So I'm going to go into kind of, actually, let me go back real quick. When we went private in 2019, we were 7.7 times debt to EBITDA. We went out of the IPO at 0.3 times debt to EBITDA. Okay, so, very different scenario. And I always say, and Prem and I always, giggle about this a bit. I say, Prem, you can only have free cash flow if you have cash flow in the first place. Okay, you can create free cash flow by, again, having resiliency and by structuring your balance sheet. And he agreed with that. That's what we've done. But, ultimately, what we do in the case of that is we turn around and we focus. So, the value investing side now is to take a look at what we have as resilient growth, and then how do we tack on a growth strategy? I'm going to talk about that in a second. So, when I look at the case study, okay, number one, this is the competitive moat, right? I got to update the slide. It's 40 manufacturing facilities because there's a new plant being built in India that's going to commission in October of 2026. What's the strategy here? Today, to rebuild these assets would take us 3x from a book value perspective on replacement cost, and likely I wouldn't do it in my career. So another 15 years, it'd be very difficult to replicate, 40 manufacturing facilities in 5 continents around the world, all with a strategic footprint related to the integrated supply chain. So it's either in the growing region or at a port location, and there's some interconnected strategy, including our Turkish asset base that's located 8 kilometers from the seaport of Mersin, which is the main agricultural seaport in the Mediterranean in Turkey, that has grown from 100 million of revenue to $1 billion in revenue in the last 5 years and accounts for 60% of our earnings today. And when we took it private, it was 18% of our earnings. So, again, the value pool that we look at is something, and I tried to bring it out actually today in our first conversation, so I didn't want to get into be too geeky on the accounting side, but remember on your book value discussion, right, when you're in a devaluing currency environment and you're translating back to a dollar balance sheet, right, our Turkish assets at one point were $35 million Canadian on our balance sheet and a $600 million valuation. Because the Turkish lira went from 1.47 to the dollar to 44 to the dollar over the last 13 years. Yeah, well, yeah. Well, we're doing okay on Eurobank now, but it took a little bit of time, right? So anyway, but the point is that as we look at these companies, right, asset-heavy companies, there are value pools that you're looking at, right? You know, are the assets right? Are they located in a cohesive fashion that generates additional cash flow? What's the replacement cost versus the ability to scale them? All of these things are things that we look at, right? Integrated supply chain, where you take in your manufacturing footprint and then you put in place an R&D and innovation system. So we're now looking at the major trend in the world is plant-based protein and dietary fiber. Now I'll tell you what's coming. There's an earthquake coming in the food industry. GLP-1 drugs are an earthquake. It's not just a change. So, you know, by 2030 to 2031, GLP-1 will come off a patent. The cost of GLP-1 drugs will go from $1,000 average a month down to $90 a month. This is going to fundamentally change the entire consumption of the world in terms of protein and dietary fiber. So when we look at that, you know, what we're doing now is we're preparing products like our veggie pasta, which is 24 grams of protein per single serving of pasta. We introduced it at Whole Foods USA 41 weeks ago. It's number 9 in the category in the US now. So when we look at that, and on the back of the box it says, this product is made from one ingredient, red lentils. Right? Consumers are looking for mouthfeel, texture, affordability, and they're looking for alternative ways to consume protein. Now on our roadshow, I had a woman from one of the funds here in Toronto come up to me, and she bought on the IPO, and she said, I get it. My son's an athlete, the other twin. So I said, you know, my son eats 6 eggs and 5 chicken breasts in a sitting, right? He was a college football player. Most consumers don't eat that way, right? But, you know, a 48-year-old woman who wants to get 50 grams of protein wants a single serving of pasta, 1 chicken breast to give her 50 grams of protein per serving. This is the trends that are moving. So when we look at, you know, us, we were in a position where another side of North Americans is we're so US-centric. So, you know, Prime Minister Carney, you know, got this slide when I met him the last time, and he was like, oh my God, I can't believe it. Canada, US are only 12% of your revenue, right? That's the growth area for us. It's not the one that's handcuffed us. I ended up in the Calgary Herald, the front page, because I said, we all one day are going to thank Donald Trump for what we're going through today in Canada. And people were like, what do you mean we're going to thank him? And we are going to thank him because he didn't just slap us in the face, he punched us in the nose. And, you know, I always say, I'm an ag guy from Western Canada. When the sun shines, make hay, right? When the sun shined and we were making cash flow in the US for the last 4 decades, we didn't make hay in this country, right? We sat on our laurels and rested on the fact that we were sitting next to the richest market in the world. So trade diversification is an important part, you know, of the future. So when we kind of look at where we're going, it's again, strategic growth across our core segments. So, you know, what we were talking about earlier is modular growth. So we have a big pasta plant in Turkey, right? We add 40% more capacity, and ultimately we get this operating leverage growth profile that's completely different. So the first 12 lines deliver a return, the last 4 deliver another. Let me give you the India metrics real quick. We're building a plant in India to produce pasta to export to Japan and Asia and the US and Europe. Number 1, Modi signs a free trade agreement with Europe. So no tariffs and no duty now on pasta from India. Number 2, Trump and Modi sign an 18% tariff. We know what the tariff is there. Number 3, capital cost is 30% of the US build. Number 4, 12 months shovel in the ground of production in India. I can't even get an approval in North America in 12 months to start a project. Number 5, operating costs 50% per metric ton compared to a US or Canadian build. Number 6, Navasheva, India to New York, Chicago, Long Beach, Houston, and Miami, cheaper by ocean freight than truck freight from North Dakota. That's the competitive moat that we talk about. So you know what? What we're executing now is a modular CapEx strategy to grow capacity in cost-advantaged regions to create that return on invested capital. Now, I think that, I'm going to kind of end because I want to get to Q&A, and George, I'm the last speaker of the day, so I want to get done here. But, ultimately, look, again, please, as investors, just, think hard about abandoning things like ESG. I mean, there's a place for it. There ultimately is environment and governance side in particular, and the social side of our business is an important part that we think creates value for our investors long term. Like our social side is our employee health and safety. What if I told you that last year out of our $3 billion in revenue, $800 million were the United Nations agencies? That's not philanthropy for us. That is a major profit-making business. Okay, and we're developing and delivering a supply chain that makes it affordable for the UN to feed more refugees. So we're not doing this. Again, you want to be philanthropic, go donate, time or money. But if you can align profit and purpose, you can ultimately make returns that actually have no opposition. Your board will be happy, your shareholders will be happy, your consumers will be happy, and your entire stakeholder chain will be happy if you can ultimately align that profit and purpose. So that's where we're trying to go. So George, I ran through a lot of things, but I think that the message I wanted to leave you guys with, actually before I go here, I just got a couple of other notes here I want to just, because these are from the speakers from today. So for Barbara Ann, I kind of talked to her already, but listen, here's the trouble, right? You want to have a value scenario. If it's visible to everybody, it's not going to be easy to capture it. You have to create value in a lot of cases, right? That's ultimately it. It's the alignment of a plan that creates value. So as Barbara Ann said, build the scale instead of waiting for the market to weigh the value, right? That's an important thing. If you look at the 25-year journey of starting to originate from farmers and building a manufacturing footprint around the world and building an integrated supply chain and now taking it up to plant-based protein, there's a strategy here that ultimately we believe have strong fundamentals. I wrote down here, bigger, stronger, faster. So I sent my 25-year-old son a picture of the Bionic Man today. So as I was listening to the value investing talk, it's apparent to me that bigger, stronger, faster. Scale matters in creating value. And I think that that's an important thing, that we have to recognize that inflation is here to stay. And when it comes to staples, affordability is something that people forget about. So whether you are the richest or poorest consumer, affordability of the products that you don't have discretionary spending decision on is an important consumer decision. So that's where I think scale is important. And then I wrote down here, one more. Arbitrage is not a word that people talked about today. To me, again, there's a misguided view of investors that arbitrage means speculative risk-taking. In my mind, arbitrage is the exact opposite. Arbitrage is actually monetizing limited price discovery. What I'm doing in India on construction cost is arbitrage. Operating costs in India or regulatory approval, and the freight and logistics is arbitrage. So to me, arbitrage is a very key element of creating long-term value, because you are actually recognizing and exploiting inefficiencies in the market, and you're able to monetize those. That's not speculative. In fact, that's very calculated. And if done correctly, it can be very, very important. I said commodity is not a dirty word. In fact, supply chain is critical. And then the last one is, as investors, your value investors, don't think that a Middle East war is a systemic risk for one company or another, right? This is a global event, right? So, when you look at these things, ensure that you're recognizing how does it affect the companies that you're invested in, let's say these kinds of events. And what's the short-term impact? And then ultimately think about what's the longer-term impact of that crisis, right? In our case, if we look at staple foods, we believe that the long-term impact is actually enhanced demand in the Middle East over the next year and two. So a short-term disruption of supply chains will ultimately lead to sustained demand because food is becoming more and more a concern. I can tell you every single government in that region is worried because rice stocks and lentil and chickpea and wheat stocks are running low. So, you know, these are the kind of things that I want you to do. And the last point I wanted to say is choose your investor carefully, somebody said earlier. I think that was you, Dom. Like, so important, right? When I look at, you know, again, I was so fortunate to have Prem Watsa come to me and say, will you let me be your partner? And when we did the IPO, Prem didn't sell a single share. I didn't sell a single share. And Fairfax put in $200 million of new capital into the IPO. So that's a signal. We went down to the US and they're looking at me and going, what do you mean? You and Prem own 67% of the shares and you're not selling any? We're like, no, we're not. Well, what are you doing with the money? We're going to retire all the debt and we're going to grow free cash flow. So choosing your partner is important, but it's that alignment of where their capital source comes from. When I was trying to decide what to do as a founder to take it private, I didn't want private equity because I didn't know what their time horizon would be. Even if they told me it was 5 to 7, I don't know if I believed it. I didn't want a fund that had redemptions because then I couldn't control the exit time period. But how about somebody with a float who's growing, right? Who ultimately, if I provided the right, you know, opportunity, transparency, honesty, and trust, there's no time horizon. So that alignment of investor time horizon as a value investor yourself and as a founder growing your business, that's probably one of the most critical decisions. So George, I'll stop.